Paul, thank you very much for joining us on Trade Finance Talks TV.
Hi Deepesh, and thanks for having me.
So, elevator pitch in no more than 30 seconds. Who are you, where are you from, and what do you do?
I'm Paul Kohls. I am the Asset Distribution Lead within the Trade Transformation Programme at HSBC, and my other day job is Chair of the Market Practice Committee at ITFA. I've been in the trade finance industry for almost 25 years now, mainly in the distribution space. And I started off at London Forfeiting and have also been at ABN AMRO, RBS, Bank of America, and more recently HSBC.
Great, thank you. So lots of experience and I guess lots to keep you very busy. So as head of the Market Practice Committee, what are your key responsibilities?
So the Market Practice Committee tries to understand what issues could impact our industry, and in particular the secondary market for trade finance, but also wider issues in trade finance that can have a repercussion on our activities on a daily basis. So some of that can be just understanding what's happening in the industry, what's happening from a regulatory perspective, trying to decipher some of these impacts, and looking at providing guidance to our members, trying to give some practical advice. And another aspect is trying to create some consistency and maybe standardization of how to do our activity. So again, where we see there's extra value is for the smaller institutions in particular that might not be aware of what's happening and what might be coming their way or how to implement changes. So we're really there to look into these matters and then try and communicate that out to our members.
Thank you, Paul, for the overview on some of the initiatives going on within the Market Practice Committee. Can you talk about any of other initiatives either going on at the moment or upcoming initiatives?
Sure. I mean, one of the related aspects is obviously with the LIBOR demise. We're working on the revised wording for the Master Participation Agreement. So we're working with BAFT, and we'll provide updates on that very shortly so everyone can have a new version of that document that covers the removal of LIBOR. And then other important things that we're coming up with, we've got 2 new members in the Market Practice Committee that will give us a new angle to what we're looking into. So one on the funds and institutional investor side, and the other more from a fintech and documentation improvement aspect, how we can really look at standardizing some of the work we do, looking at the impact of electronic signatures and so on.
So what are the really big things that are going on right now that are kind of keeping you up at night?
I think the biggest topic recently has been LIBOR transformation. And as you know, we've set up the hub with TFG. So that's been a really useful initiative for everyone, because it just means there's a central location that people can go to and find out more about the latest changes. And this is obviously far-reaching in terms of the impact on the industry, but not always very obvious to know where things have got to. And things change from week to week, so it's very difficult to pin down what's happened recently if you're not looking for it. So I think that's one of the big issues that's really been evolving over the last few years, but it's really coming to a head now with some key cut-off dates for the transition periods.
Yeah, certainly a huge challenge for bankers and banks all around the world. Another thing that's been going on that we've heard a lot from ITFA is the focus on structured letters of credit. Why has this been the case?
Again, looking at what the industry was looking for and what our members were asking about, it's a product or a sub-product within the letter of credit world and in trade finance that I guess had a little bit of mystery attached to it. People had very different perceptions, and from a Market Practice Committee we were thinking this is an area where we probably need to increase the transparency around what does this product do and not do. So not really trying to assess its worth in absolute terms, but just highlight these are the differences between a structured letter of credit and a typical traditional letter of credit, and allow people to understand those differences, where the different risk profiles might lie, but also what's similar. So just to really remove the grey areas as much as possible and allow people to make their own informed decision. So very much a practical guide to understanding more about something that was maybe a little bit obscure in the past.
So, Paul, what are the most common misconceptions around structured letters of credit, and what does ITFA guidance suggest?
What it's really focused on is where the grey areas are, where there are maybe assumptions that are made by people historically around what the structured letters of credit do and don't do, and how they would maybe perform in the event of a default or a fraud. So that's where the guide really tries to go into detail around the relative risks and operational aspects that people need to look into, just to fully understand what they're looking at, and then make their own informed decision as to how they feel about it, do their own risk assessments. But broadly speaking, they have a reference point and know which are the flags and indicators that they need to focus on.
Yeah, great. So let's talk about one of our favourite topics, I guess, the LIBOR transformation for trade finance. And we know the world's most important number is being phased out to risk-free rates or alternative rates. We'll skip the why and talk about the what. What does this mean for trade finance, given that LIBOR is still very much the default benchmark rate?
Yeah, I mean, thankfully, a lot of clarity has come about in the last few months when we've been coming up to some of these key deadlines. But I think early on, the pain points for the industry were not understanding how it would apply to products such as discounting, which happens frequently in trade finance, for example, in the open account space, supply chain, but also where you have bill discounting under a letter of credit, for example. So any discounted product would need a term rate. And this is where there was a lot of confusion as to whether the transition away from LIBOR would give us term rates for these new risk-free rates that were going to be published. So the real understanding had to be, what does trade finance do if there's no term rate? Thankfully, because of putting forward the case of how important it is for trade finance, we now have term rates for US dollars, also for GBP. So it's a good step forward, and we can look to integrate that. But the other challenges are you have potentially multiple publishers for these new rates. So you have to choose which one to use. Different banks, different parties into trade finance may choose different rates. So there's quite a lot to still unravel. And of course, from a systems perspective, you then have to figure out, okay, where's my new feed coming from? And what does it look like? Does it match like for like with what was published as LIBOR before? Those are the issues that have really impacted trade finance so far.
Yep. And in your opinion, how prepared are banks for this transition to risk-free rates?
That's a very good question. I think it's changing day by day. It depends how much of it can be done manually and how much is systems driven, but also the migration of client documentation and operational processes. If you think of the secondary market, it's different also to the origination aspects of trade finance. So, for example, if you are originating a trade finance transaction, typically the bank will state what rates will apply. When it's between two financial institutions, they look to a mutual third-party rate. So you already have this little difference in how it operates. You have to reflect that in the documentation. So updating all the documentation is a key part of this whole LIBOR transition journey, and making sure everyone understands what you're moving to and when you're doing it. And of course, I think operationally, again, what are the points that you're referring back to? Where do you get this rate from? So the banks, I think, are probably quite far advanced when it comes to origination, and that journey with the clients. When it comes to the secondary market, there's still some, I guess, mismatch, because it's a slightly different process and it may or may not be automated. The documentation may still be in the updating process. Both parties are probably aware of what's going on, but how to make that happen and when to make it happen is still maybe evolving on a day-to-day basis.
Yeah. Well, Paul, I'm afraid that's all we've got time for, but thank you very much for your update and I guess giving us a bit of a roundup of what's going on within the Market Practice Committee. I think there are still lots of really important papers and documents coming out over the next few months or so, and particularly in and around that LIBOR transformation, but also lots of very good information providing clarity to for members on items like structured letters of credit. So thank you very much.
Pleasure. Thank you.